It's Sunday evening, 12th of January, 2026. I'm sitting here watching something I have not seen in 12 years of tracking this market. The financial networks are showing their usual ticker parade. Green here, red there. CNBC is talking about tech stocks. Bloomberg has some talking head explaining why the markets are resilient. But there's this eerie quiet about what's actually happening right now in the metals sector. I've been a private commodities analyst and physical silver stacker for over a decade. And I built this channel using this AI avatar for one reason: speed. I'm tired of waiting half a day for mainstream outlets to catch up to what I'm seeing in real time on my feeds. And frankly, I'm tired of all these other AI channels pumping out fake hype about silver when real information is what retail investors actually need. So here's what they're not telling you. While you were watching football this weekend, a criminal investigation was launched into Jerome Powell, the chairman of the Federal Reserve, the man who controls the money printer. And I'm not talking about some procedural review or ethics committee slap on the wrist. The Department of Justice is investigating him over his 2024 congressional testimony and some office renovation expenditures that apparently raised red flags. The media is framing this as a minor volatility event in the metals sector. They're telling you the Fed is still independent, still in control, still the steady hand on the wheel. But the physical silver market just told you something very different. American Silver Eagles, the benchmark 1-ounce coin that every stacker watches, just crossed $100 at major dealers. Not the spot price. The spot price is sitting at $85.55. I'm talking about what you actually pay to get physical metal in your hand, $100. That's not a typo. That's not a temporary spike. That's the new floor for physical silver, and it happened in the span of about 48 hours. For the first time in my career, the gatekeepers are being investigated by their own Department of Justice, and the physical market just called their bluff. The Fed opened Pandora's box, and I don't think they're going to like what's inside. Here's my primary claim, and I'm going to spend the next hour proving it to you with data, math, and real market mechanics. The DOJ's criminal probe into Powell has shattered the illusion of Federal Reserve independence. That loss of trust triggered a massive safe haven flight into hard assets, and that flight caused the physical silver market to completely decouple from the paper exchange. We are no longer trading a commodity, we are trading a crisis proxy. I'm going to walk you through what I call the premium gap mechanism. I'm going to run the stress test math on these $100 eagles. And I'm going to show you exactly how I'm positioning my personal portfolio to survive what looks like a shadow war between the Federal Reserve and the Department of Justice. If you think $100 is the ceiling, you haven't seen the data I'm about to show you. Because there's a rumor circulating on the institutional desks right now about something called the LBMA short squeeze. And if that rumor is even partially true, we're not talking about $100. We're talking about $150 in hand while your screen still shows 100. Let me give you the snapshot. I pulled this data a few hours ago at 2 p.m. Eastern Standard Time. Gold hit $4,610.54. That's a new all-time high. Silver spot closed at $85.55, up over 7% in a single session. That's a massive single-day move for silver. But here's where it gets strange. While spot was printing $85.55, I opened up APMEX, then JM Bullion, then SD Bullion. Every major dealer in the United States had moved their brilliant uncirculated American Silver Eagles to $100 or higher. Some were listing them at $102, $105. The smaller regional dealers were even higher because they were scrambling to restock from wholesalers who were already out. Stop for a second. Look at that gap. The paper price says 85. The physical price says 100. That's a 17.5% premium. In a normal market, premiums on Silver Eagles run about $3 to $5 over spot. Maybe $8 if supply is tight. 17% is not normal. 17% is a divorce. The inventory situation is what really caught my attention. I have a contact at a mid-sized dealer in Texas. He told me this morning that his weekend order volume was 4 times his normal Saturday traffic. People were buying anything they could get. Eagles, maples, generic rounds. It didn't matter. They just wanted physical silver before the psychological barrier of $100 scared them off. But why is the physical price moving so much faster than the screen? Because of a mechanism most investors don't understand. And if you don't understand this mechanism, you're going to get fleeced by the headlines over the next few weeks. Let me pull this apart. The key mechanism here is physical versus paper decoupling. I call it the premium gap. This is the divorce between the futures contracts traded on the COMEX and the physical metal you can actually hold in your hand. These are two different markets. They're supposed to track each other, but they don't always. And right now, they're not even in the same zip code. Here's the simple definition. The spot price you see on every financial website is derived from the COMEX futures market. That's a paper market. It's a contract that says you have the right to take delivery of silver at a certain price on a certain date. Most of those contracts never result in actual delivery. They're just bets on the direction of the price. Traders close them out before expiration. It's a casino, and the chips are paper. Physical silver is what you buy from a dealer, what you hold in a safe, what you can't create with a keystroke. There's a finite amount of it. It has to be mined, refined, minted, shipped, stored. It has mass, it has scarcity, and when everyone wants it at the same time, the price has to rise until enough people say no thanks. Think of it like this. Imagine the official price of a concert ticket is $85 on the venue's website. But when you go to buy, the website says sold out. Every ticket is gone. Now, if you really want to get into that show, you have two options. You can wait and hope the venue releases more tickets at $85, or you can go outside the stadium where scalpers are selling tickets for $100. The $100 is the real price. The $85 is just a ghost. It's a number on a screen that no longer reflects reality. That's where we are with silver right now. The COMEX is telling you $85. But if you try to buy physical silver at $85, you're going to get laughed out of the dealer's shop. The real price, the price you actually pay to acquire metal, is $100. And here's why it's a trap. If you only watch the ghost price on the news, you'll never understand why your local coin shop has no silver left. You'll see the spot price dip to $80 next week and think, great, silver is getting cheaper. But the dealer will still be charging $95 or $100 because the physical supply hasn't returned. The paper market is suppressed by institutional players who have an interest in keeping the price low. But the physical market is in price discovery. It's telling you what silver is actually worth when people want to hold it instead of trade it. The gap is widening because of a rumor that's leaking out of the institutional desks right now. I heard it from two separate sources. Both of them work at firms you've heard of. The rumor is that a major London Bullion Market Association vault is facing a delivery default. A big player, could be a sovereign wealth fund or a central bank, put in a massive order for physical silver, and the vault can't deliver. They don't have it. They sold paper claims on metal they didn't own, and now someone called their bluff. I can't verify this rumor. I don't have a source inside the LBMA. But I can tell you that the premium explosion we're seeing is consistent with a delivery squeeze. When institutions realize they can't get metal at paper prices, they start bidding in the physical market. And that's when retail investors like you and me get priced out. Now let's run the math. I'm going to give you two scenarios, a conservative one and a stress test one. You can decide which one you think is more likely. Conservative scenario. Let's assume the premium gap stabilizes at 17.5%. That's where we are right now. If spot silver continues to climb and hits $100, simple math says physical eagles would be priced at $117. You're paying $117 to get a 1 ounce coin that the screen says is worth $100. That's the cost of scarcity. Stress test scenario. If the LBMA short squeeze rumor is true and institutional delivery fails, escalate, we could see premiums hit 50%. I know that sounds insane, but it's happened before in other commodities during crises. 50% premium on $100 spot puts physical silver at $150 in hand. You'd be paying $150 for a coin while your TV says the price is $100. Let me show you why I think the stress test scenario is not as crazy as it sounds. I was looking at the technical indicators a few hours ago. The relative strength index for silver is at 77.9. That's overbought territory. Historically, when RSI gets above 70, it's a warning sign that a pullback is coming. Traders see that and think, time to sell, take profits, wait for the dip. But the physical demand doesn't care about technical indicators right now. The RSI is screaming overbought, and yet dealers can't keep inventory on the shelves. That tells me this is not a normal technical rally. This is a fear-driven accumulation event. People are not buying silver because they think it's going to 90. They're buying silver because they think the financial system is breaking. Here's another data point that doesn't make sense in a normal environment. The US dollar index, the DXY, is showing resilience. It's not collapsing. Usually, when the dollar is strong, precious metals get crushed. That's the inverse relationship everyone learns in Econ 101. Strong dollar equals weak gold and silver. Weak dollar equals strong gold and silver. But right now, both are rising. The dollar is holding, and gold just hit an all-time high. Silver is up 7% in a day. That should not happen, unless this is not a currency trade, unless this is a liquidity black hole event. Money is fleeing into anything that feels safe. Dollars, gold, silver. It doesn't matter. People just want out of risk assets. The numbers don't match the history books because the history books didn't account for a Federal Reserve chairman under criminal investigation. That's the variable no one priced in. The Fed's independence was always a myth, but it was a useful myth. It kept the system stable because people believed the Fed was above politics, above corruption, above reproach. That belief is gone now, and once trust is gone, price discovery gets violent. I know what the skeptics are going to say. I've already seen it in the comments on other channels. So let me address the strongest counter-argument head-on. Skeptic argument number 1. This is a politics-induced blow-off top. The RSI is overextended. Once the DOJ headlines fade and the investigation turns out to be nothing, silver will crash back to $70. This is just retail hype driven by fear-mongering YouTubers. Here's my rebuttal. Now, I would agree with you if this were just a retail-driven rally. Retail can't move markets this size. Retail doesn't have the capital, but this is not just retail. I saw a Morgan Stanley research note that came out Friday. Their entire commodities theme flipped to stick with metals. They are now telling their institutional clients to buy silver as a fiscal risk hedge. When the big banks start telling their clients to buy the thing they usually tell them to avoid, the floor moves up. Morgan Stanley is not a silver permabull. They don't care about silver. They care about making money for their clients. And if they're rotating into metals, it's because their risk models are flashing red. Let me myth bust another idea while we're here. The idea that higher rates always mean lower gold and silver. That's the narrative you'll hear on CNBC. The Fed raises rates, gold and silver fall because they don't pay yield. Cash and bonds become more attractive. It's a simple story. It's also wrong. Go back to 1979 and 1980. The Volcker Fed raised interest rates to 20%, 20, and silver went to its all-time high of $50 an ounce during that exact period. Why? Because the market didn't trust the Fed. Rate hikes were seen as proof that inflation was out of control, not proof that the Fed had it under control. The market was front-running the chaos. We could be in a similar setup. If the Fed hikes rates this year to try and restore credibility, it might have the opposite effect. It might signal that they're panicking. And if the DOJ probe continues, every rate hike is going to look like a desperate attempt to save face. Let me do a quick checkpoint recap before we move forward. We've seen the $100 physical breakout. We've defined the premium gap and why it's a divorce between paper and physical. We've analyzed the DOJ investigation and why it's a trust event, not just a political sideshow. Now, what comes next? Here's what I'm watching. The institutional reaction, specifically the COMEX. When the paper market starts losing control of price discovery, the exchange does what it always does. It hikes margin requirements. That forces retail traders who are long silver futures to either post more cash or close their positions. It's a way of shaking out the weak hands. And it works. Every time they hike margins, you see a temporary dip in price as traders liquidate. I expect the COMEX to announce a margin hike within the next week, maybe 2. If they do, the spot price will probably pull back to 80 or 75. The financial media will say, see, the rally is over, silver is crashing. But if you understand the mechanism, you'll know that the paper price dipping does not mean the physical price is following. The dealers might drop their premium slightly, but the $100 floor is likely sticky now. I'm also watching the gold to silver ratio, the GSR. This is the number of ounces of silver it takes to buy 1 ounce of gold. Right now, with gold at 4,600 and silver at 85, the ratio is about 54 to 1. Historically, the long-term average is around 60 to 1. When the ratio drops below 50, it's usually a signal that silver is outperforming gold. It means silver mania is starting. If we see the GSR break 50, I'm expecting a face-melting rally in silver. The kind of move that gets normies asking their financial advisors about buying coins. That's when it gets dangerous, not because silver crashes, but because premiums go parabolic. You could see 40 or 50% premiums when retail panic buying hits. The media response is going to be predictable. Expect a coordinated silence at first. The major networks won't cover the silver story because it's inconvenient. It raises questions about Fed credibility, central bank manipulation, the stability of the financial system. Those are topics they avoid. When they do cover it, they'll call silver a meme metal. They'll compare it to GameStop and AMC. They'll bring on some analyst who says this is retail speculation driven by social media. They'll do everything they can to discourage the masses from buying. And that's exactly when you should be paying attention. Because the media's job is not to inform you. Their job is to manage your behavior. Now let me tell you about the wildcard scenario. I call it hike to spite. There's an unverified rumor circulating that the Fed might hike rates aggressively this year, not to fight inflation, but to crash the economy and undermine the DOJ investigation. The logic goes like this. If Powell is facing criminal charges, his best defense is to show that removing him or weakening the Fed would be catastrophic for markets. So he engineers a controlled crash, blames it on political interference, and uses the chaos to rally support. I don't know if this is true. It sounds like a conspiracy theory. But the Fed has done stranger things. And if it is true, we're entering a period of extreme volatility. Rate hikes would crush equities and real estate, but they might send gold and silver even higher as people flee into hard assets. The playbook gets messy. So in this chaos, what am I actually doing with my own money? Let me give you my personal battle plan. This is not advice. This is just what I'm doing. You do your own research and make your own decisions. Trigger number 1, the $80.50 support test. If spot silver retraces to 80.50 and holds, I'm viewing that as a structural confirmation to stay aggressive. That means the rally has legs. The dip buyers are still in control. If it breaks below 80 and keeps falling, I'm going to lighten up. I'm not trying to catch a falling knife. Trigger number 2, the 25% premium cap. If physical premiums hit $106 while spot stays at 85, I'm personally sitting on my hands. I refuse to pay a 25% panic tax to dealers. At that point, the risk reward is broken. I'd rather wait for the premium to compress or the spot price to catch up. Trigger number 3, the GSR at 50. If the gold to silver ratio hits 50, I will be looking to rotate a portion of my silver gains back into gold. Not because I'm bearish on silver, but because I want to lock in profits and rebalance. Silver is more volatile than gold. When it runs hard. But when it crashes harder. I don't want to be the guy holding the bag at the top. Here's my personal stance. I'm not buying the ghost price. I'm not making decisions based on what the screen tells me. I'm watching the local shop availability. If the supply vanishes completely, the price becomes irrelevant. You either have it or you don't. And if you don't have it when the system breaks, good luck getting it at any price. I'm using conditional if-then logic. If the Fed caves to the DOJ and Powell resigns or gets removed, I expect a short-term dip in metals as the market interprets that as a resolution. If the Fed fights back with spite hikes and tries to weaponize monetary policy, I'm holding for the long haul, because that would be the final proof that the system is broken. Let me recap where we are. The Department of Justice opened Pandora's box by investigating Jerome Powell. That shattered the illusion of Fed independence. The physical and paper silver markets decoupled. $100 is the new real floor for American silver eagles, even though the spot price is 85. We've explained the premium gap mechanism, we've run the math on conservative and stress test scenarios, and we've addressed the skeptic arguments. Now, I want to take you deeper into the historical context, because if you don't understand how the Fed has intervened in metals markets before, you won't recognize the playbook they're about to use. Go back to 1980, the Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, and they tried to corner the silver market. They bought physical silver and silver futures contracts. At one point, they controlled almost half of the world's deliverable silver supply. The price went from $6 an ounce in 1979 to $50 in January 1980. The establishment panicked. The COMEX and the Chicago Board of Trade changed the rules mid-game. They banned new long positions in silver futures. They hiked margin requirements. They implemented delivery limits. All of that was designed to force the Hunt brothers to liquidate. And it worked. Silver crashed from $50 to below $11 in a matter of weeks. The Hunts went bankrupt. Here's why that matters now. The Fed and the exchanges have a playbook. When the price of silver starts threatening the system, they change the rules. They don't let the market run free. They intervene. And they always justify it as protecting market stability, preventing manipulation. If we see a repeat of the Hunt brothers scenario, you need to understand what it looks like. First, you'll see margin hikes on the COMEX. That's already in the cards. Second, you'll see delivery restrictions. The exchange might say you can only take delivery of a certain amount of silver per month. Third, you'll see coordinated media attacks. The financial press will say silver is a bubble, it's irrational, it's being manipulated by retail speculators. The goal is to scare you into selling. And it works on most people. They see the price drop 20% in 3 days and think, I need to get out before it goes to zero. But if you understand the playbook, you know that the dip is artificial. It's not driven by fundamentals. It's driven by rule changes designed to break the rally. Now let me contrast that with what's different this time. In 1980, the Hunt brothers were trying to corner the market for profit. They were speculators. The Fed could paint them as villains. But in 2026, the buying is not coming from two billionaires. It's coming from sovereign wealth funds, central banks, pension funds, and retail investors who are terrified of what the DOJ investigation means for the dollar's stability. You can't paint that as manipulation. You can't say that retail investors buying silver eagles are trying to corner the market. The demand is decentralized, it's global, and it's driven by a loss of trust in the system. That makes it much harder for the Fed to intervene without looking like they're rigging the game. There's also the geopolitical angle. I'm seeing reports that China and Russia have been accumulating gold and silver reserves for years. If they smell blood in the water, if they think the U.S. financial system is weakening, they might accelerate their accumulation. That would put even more pressure on the physical supply. And it would turn the silver market into a proxy battleground for a much larger economic war. I also want to address the international angle. The U.S. is not the only country dealing with a crisis of confidence in central banks. The European Central Bank has been under fire for years. The Bank of Japan is trapped in a zero-rate policy and can't escape without crashing their bond market. China's economy is slowing. The entire global monetary system is under stress. When central banks lose credibility simultaneously, the flight to hard assets becomes a stampede. It's not just Americans buying silver, it's Europeans, Asians, Middle Easterners. Everyone who has access to a dealer is trying to get physical metal. And the supply is finite. There's only so much silver mined each year, only so much inventory available for delivery. That's why I think the physical paper decoupling is not a temporary glitch. It's the new normal. As long as trust in central banks is broken, the premium gap will persist. You will pay more to hold physical than to trade paper, and that premium is the price of certainty in an uncertain world. Let me give you a layer of the COMEX intervention playbook. It's not just margin hikes. The exchange can also implement position limits. That means they cap how many contracts any single entity can hold. The stated reason is to prevent manipulation. The real reason is to prevent large players from forcing delivery. If you own 10,000 silver futures contracts and each contract is 5,000 ounces, you have the right to demand delivery of 50 million ounces. That's a lot of silver. If the COMEX doesn't have it in their vaults, they're in trouble. So they cap your position at, say, 1,000 contracts. Now you can only demand 5 million ounces. Still a lot, but more manageable. Watch for position limit announcements. If the COMEX suddenly announces new limits on silver futures, it's a signal that they're worried about a delivery squeeze. And that's actually a bullish sign for the price of physical silver. It means the exchange is admitting indirectly that the paper market is fragile. Here's another scenario I'm gaming out. The Strategic Petroleum Reserve. You've heard of it. The U.S. government keeps a reserve of crude oil in case of emergencies. What if the government decides to create a strategic silver reserve or a strategic precious metals reserve? They could justify it as national security. Silver is used in electronics, solar panels, weapon systems. If there's a supply shortage, it's a threat to infrastructure. If the government starts buying silver to build a reserve, that's game over for the bears. The price would go vertical. Because now you're competing with unlimited fiat currency backed by the full faith and credit of the United States. You can't outbid that. I don't think this is likely in the near term, but it's on the table. And if the DOJ investigation escalates and the Fed's credibility collapses, the government might feel pressure to do something dramatic to restore confidence in the dollar. Announcing a precious metals reserve would be one way to signal strength. Now let's talk about the supply side. Silver is unique because it's both a monetary metal and an industrial metal. About half of silver demand comes from industry. Electronics, solar panels, medical devices, water purification. The other half comes from investment and jewelry. If we're in an economic slowdown, industrial demand for silver should drop. That's bearish. But if we're also in a monetary crisis, investment demand should surge. That's bullish. The question is, which force wins? Right now, it looks like investment demand is overwhelming any slowdown in industrial demand, but that could change. One thing to watch is the solar industry. Solar panels use silver paste in the photovoltaic cells. If there's a solar boom, that could tighten physical supply even further. On the other hand, if solar subsidies get cut or the industry slows down, that frees up silver for investment demand. The mining side is also critical. Silver is mostly mined as a byproduct of other metals: copper, lead, zinc, gold. Only about 30% of silver comes from primary silver mines. That means silver supply is not very responsive to price. If the price of silver doubles, you can't just open new silver mines overnight. It takes years to develop a mine. That inelasticity of supply is bullish in a demand surge. The market can't quickly adjust to bring more silver online. So the price has to do all the work. It has to rise until enough marginal buyers say, "That's too expensive, I'm out." And given the monetary crisis dynamic, I'm not sure where that clearing price is. Could be 150, could be 200, could be higher. I want to give you one more historical comparison. Weimar Germany, 1923, hyperinflation. The currency collapsed. People were burning money for heat because it was cheaper than buying firewood. In that environment, physical goods became the only store of value: silver, gold, real estate, tangible assets. The US is not Weimar Germany, not yet. But the loss of confidence in the Fed is the first step on that path. If people stop believing the Fed can control inflation or maintain the dollar's stability, the demand for hard assets will accelerate. And silver, because it's more affordable than gold, will be the primary vehicle for middle-class savers trying to protect themselves. That's the demographic driving this rally. It's not the ultra-rich. They're buying gold, art, real estate. It's the middle class, the people who have 50,000 or 100,000 in savings and are terrified of it getting inflated away. They can't afford to buy 10 ounces of gold at $4,600 each, but they can buy 100 ounces of silver at $100 each. It's accessible, it's tangible, it's insurance. Let me tell you what happens if the Fed tries to pivot and cut rates. Let's say the DOJ investigation fizzles out. Powell survives. The Fed decides to cut rates to juice the economy. In a normal world, that would be bearish for the dollar and bullish for silver. But we're not in a normal world. If the Fed cuts rates after this crisis, it will be seen as surrender. It will signal that they have no credibility, no independence, and no control. The market will interpret that as weakness, and the flight to hard assets will intensify. So even a dovish pivot could send silver higher. That's the trap the Fed is in. They're damned if they hike, damned if they cut, damned if they hold. The only way they restore credibility is if the DOJ investigation concludes with Powell being fully exonerated and the media narrative shifts to the Fed saved us again. I don't see how that happens. The damage is done. The cat is out of the bag. People are questioning the legitimacy of the institution, and once you open that door, you can't close it. Here's my forecast for the next 3 months. I think we're going to see a lot of volatility. Sharp moves up, sharp moves down. The comics will hike margins. The media will call it a bubble. Retail will panic sell. Institutions will buy the dip. Then the price will rip higher again. By March, I expect spot silver to test $100. By April, I expect the physical premium to compress slightly as dealers catch up with inventory. But the $100 floor should hold. By May, if the DOJ investigation is still ongoing, I expect another leg up. Could be 120, 130 spot. Physical could be 150 plus. The risk is a black swan event, something nobody's pricing in, a war, a debt crisis, a currency collapse outside the US that triggers contagion. If that happens, all bets are off. Silver could go to 200. It could also get locked down by government emergency orders, capital controls, export bans. There's precedent for that. In 1933, the US government banned private ownership of gold. They could do the same with silver if they feel threatened enough. I don't think that's likely, but I'm aware of the risk. That's why I don't have all my net worth in silver. Diversification still matters. I have some gold, I have some cash, I have some real estate. Silver is my crisis hedge, not my entire portfolio. Let me also talk about the psychological warfare you're about to experience. The financial media is going to try to break your conviction. They're going to bring on analysts who say silver is overvalued. They're going to show charts with bearish technical patterns. They're going to interview people who bought at the top in 1980 and lost everything. The message will be clear. Don't be that guy. Sell now before you lose it all. You need to decide right now whether you're trading or holding. If you're trading, you need to set stop losses and take profits along the way. If you're holding for the long term as insurance against a monetary collapse, you need to ignore the noise. You can't do both. You can't say you're holding for the apocalypse and then panic sell when the price drops 10%. I'm in the holding camp. I'm not trying to time the market. I'm trying to survive a systemic breakdown. That means I'm okay with paper losses. I'm okay with the price going down temporarily because I'm not measuring my success in dollars. I'm measuring it in ounces. If I have 100 ounces of silver today and I still have 100 ounces next year, I won. The dollar price is irrelevant if the dollar is collapsing. That's a very different mindset from a trader. A trader's trying to grow their capital in dollar terms. They buy low, sell high, rinse and repeat. I respect that approach. But it's not what I'm doing. I'm insuring against a world where dollars don't matter anymore, or where they matter so little that holding them is a guaranteed loss. Now let me give you some practical tips for buying physical silver. First, know your dealer. Not all dealers are created equal. Some have been around for decades and have solid reputations. Others are fly-by-night operations that disappear when the market gets volatile. Stick with the established players. APMEX, JM Bullion, SD Bullion, Provident. These are names you can trust. Second, compare premiums. Don't just buy from the first dealer you find. Check multiple sites. Sometimes the difference is $5 or $10 per coin. Over 100 coins, that's $1,000. It adds up. Third, understand the products. American Silver Eagles are the most recognizable and liquid, but they also carry the highest premiums. Canadian Maples are almost as good and usually a bit cheaper. Generic rounds are the cheapest but harder to sell. Bars are in between. Know what you're buying and why. Fourth, secure your stack. Don't tell people you have silver. Don't post pictures of your stack on social media. Don't brag about it. You're making yourself a target. Buy a safe, or use a private vault service, or bury it. Just don't leave it sitting in a drawer where any burglar can grab it. Fifth, plan your exit. At some point, you're going to want to sell. Maybe you need cash for an emergency. Maybe you hit your profit target. Maybe the mania phase is over and you want to rotate into something else. Know where you're going to sell. Local coin shops usually give you the best price. Online dealers will buy back, but they take a bigger cut. Private sales can work, but there's risk. Let's talk about the international supply chains. Most silver comes from Mexico, Peru, China, and Australia. If there are geopolitical disruptions in any of those regions, the supply gets even tighter. Mexico is dealing with cartel violence. Peru has political instability. China is opaque. Australia is stable, but it's far away and shipping is expensive. If silver becomes a strategic asset, if governments start hoarding it, export restrictions could come into play. China could ban silver exports. Mexico could impose tariffs. And that would send the price even higher because the US would be competing for a smaller pool of supply. Here's a thought experiment. Imagine silver hits $150 spot. At that price, people start melting down old silverware, jewelry, anything with silver content. That flood of recycled supply hits the market. Dealers suddenly have inventory again. The premium compresses. The price stabilizes. Is that the top? Or is that just a temporary pause before the next leg up? I don't know. But I do know that 150 feels like a psychological level where behavior changes. Below 150, silver is still in the realm of normalcy. Above 150, it's officially in bubble territory. And bubbles attract attention. Media, regulators, politicians. Once silver becomes a political issue, the dynamics change. The government might intervene. The Fed might coordinate with the Treasury to dump silver from strategic stockpiles. This is why I have triggers. I'm not married to silver. I'm married to the strategy of preserving wealth. If the strategy says sell, I sell. If it says hold, I hold. I don't let emotion or ego get in the way. Let me also address the counterfeit risk. As the price goes up, counterfeits become more profitable. Fake coins, fake bars, tungsten-filled fakes that pass the weight test but fail the purity test. This is a real problem in the gold market, and it's coming to silver too. How do you protect yourself? Buy from reputable dealers. Get a Sigma Metalytics tester if you're buying large quantities. Or pay for assay services. It costs a little extra, but it's worth it. The last thing you want is to find out your stack is fake when you're trying to sell. I've seen estimates that 5 to 10% of physical precious metals on the secondary market are counterfeit. That's terrifying. It means if you buy from a random guy on Craigslist or a sketchy online dealer, there's a real chance you're getting scammed. Stick with the big players, pay the premium, sleep better at night. Now let me tie this all together. The DOJ investigation into Jerome Powell is not just a political scandal. It's a credibility crisis. It's the moment the curtain gets pulled back and people see that the wizard is just a man. The Federal Reserve's power has always been based on perception. The perception that they're independent, that they're competent, that they're above corruption. That perception is shattered. When perception breaks, price discovery becomes chaotic. Assets that were overvalued crash. Assets that were undervalued soar. Silver was undervalued for decades because the paper market suppressed the price. The physical market is now correcting that suppression. $100 is not the top. It's the beginning of a repricing. I've been in this market for 12 years. I've seen rallies and crashes. I've made money and lost money. But I've never seen a setup like this. The fundamentals, the technicals, the sentiment, the geopolitics, everything is aligned for a sustained move higher. That doesn't mean it goes straight up. It means the trend is your friend until it's not. My personal battle plan is simple. Hold the core position. Trade around the edges. Take profits on the volatility. Reinvest in the dips. Stay disciplined. Don't get greedy. Don't get scared. This is a marathon, not a sprint. Here's my rallying cry. We are witnessing the death of central bank independence in real time. The Fed opened Pandora's box when they thought they could maintain the illusion forever, but the DOJ just called them on it. And the physical silver market is the canary in the coal mine. It's telling you that something is broken. It's telling you that the paper game is over. It's telling you that if you want to protect yourself, you need to hold something real. Don't let the screen lie to you. The screen says 85. The dealer says 100. The dealer is telling you the truth. The screen is telling you a fairy tale. Trust the physical reality. Trust the local shop. Trust the fact that inventory is drying up and premiums are exploding. Those are signals. And if you ignore those signals because the TV told you everything is fine, you're going to be the one left holding worthless paper when the music stops. Things are moving too fast to wait for next week. The landscape is shifting every day. You need to understand the historical context to see where this is going. I've covered the 1980 Hunt Brothers squeeze in a previous video. That's the playbook the Fed might use to try and stop this rally. If you haven't watched it, go find it. Because the strategies they used then are the strategies they'll use now, except this time the buying is decentralized. This time the demand is global. This time they might not be able to stop it. The clock is ticking. The physical premium is widening. When the inventory is shrinking, the institutions are positioning. So the retail wave hasn't even started yet. You're early. You're ahead of the curve. But you won't stay ahead if you don't act. I know where I was. I was watching the data. I was reading the vault reports. I was talking to my contacts on the institutional desks. I was buying physical silver while the premiums were still manageable. And I am sharing this with you because I believe that retail investors deserve the same information that the institutions have. We're not second-class citizens. We're not dumb money. We're just people trying to protect what we've earned. So that's the full picture. The DOJ opened Pandora's box. The physical silver market decoupled from paper. $100 is the new floor. The premium gap is real and widening. The historical playbook says the Fed will intervene, but this time might be different. The math says higher prices are coming. The sentiment says the retail wave hasn't even started. And my personal plan is to hold the core, trade the edges, and stay disciplined, stay sharp, stay informed, and trust the physical reality over the paper illusion. I'll see you in the next one.